Hi, good afternoon, folks. My name is Peter Armitage. I'm the CEO and co-CIO of Anchor Capital. And we're privileged to have all of you here today. There's a few hundred people who've joined us already, and others are joining as we move along. But I think in the interest of respect for the people who are on time, let's get started. So I'm going to start off very briefly, just going through our asset allocation and how we're viewing the world and where we think money will be made over the course of the next 12 months. And then we've got a number of our employees, colleagues and partners who are going to run through their perspectives on the globe and their asset classes. So just to get started, the summary, every quarter we put out a asset allocation matrix document talking about where we think returns will be made. And this will form the basis on which the guys will talk. From a local perspective, you've had pretty good returns from the local market, except for Naspers and Prosus. The market is up a few percentage points this year, in stark contrast to the rest of the world. And with the backdrop of South Africa's economy recovering quite sharply, commodity markets doing very well, and it really is a commodity story so far this year. We're looking for about 9% return from local equities over the course of the next 12 months. Bonds all around the world have really battled. South Africa has been something of an exception. And in dollar terms, in the first quarter of this year, the South African bond market was close to the best in the world. We're looking for about a 10% return in bonds, which is roughly where the yield is going forward. And we think from a fairly low risk perspective, to get a 10% return turns us positive on that asset class. Likewise, listed property with similar fundamentals. There we're looking for a dividend yield of about 8% and a little bit of capital growth. So you can see not wildly exciting returns across the board from all asset classes, but I think certainly if there's one thing that we've learned over time, it's to stay invested and stay the course unless things look crazily expensive. From a global point of view, the returns are a little bit more muted than from the local market. We're seeing a lot of volatility at the moment. We've been fairly cautious on global equities over the course of the last 6 to 9 months. However, we always remind people that we invest in shares and companies as opposed to markets and indexes. So we sit fairly neutral in global equities. I think, one of the key reasons to stay invested, even though our projected return is in the region of 6%, is the markets come off about 10%. Some opportunities certainly are rising. And the truth of the matter is us experts in global macros can't tell you exactly when the market's going to move. So we think there's enough substance to stay invested in the market, although certainly some continued volatility to be expected. Government bonds around the world are, I'd say for the first time in 5 or 10 years, reaching levels where they're investable from a yield perspective again, and the US 10-year heading up towards 3%. We think global corporate credit looks pretty attractive. The 3.5% return, it's not wildly exciting, but with relatively low risk in a volatile world, they're starting to make sense in portfolios with a projected listed property return of 6%. We are increasingly showing alternative investments to our clients. And what we really mean there is investments which aren't correlated to stock markets. So they can go up because of a compounding underlying yield, or the fund managers have got the ability to not just be long only equities. So, if you're interested in that kind of space, globally, 5 to 10% returns, and locally 10 to 15% returns. So that's the landscape out there. It is a time to be cautious. There's, as you'll hear today, there's lots of things that have got us scratching our heads and we're concerned about. Interest rates are picking up. Obviously the Russian-Ukraine war, but ultimately our job is to try and assess what's priced into markets. And certainly in bond markets, we think some of it is close to priced in, and equities as time elapses and markets come under pressure, the opportunities become more plentiful. So with that, I'm going to hand over to Peter Little, who's going to give us some global perspectives.
Hey, thanks, Pete, and good afternoon to everyone. So I'm just going to talk very briefly on global liquidity conditions, and they tend to have a disproportionate impact on our investments over the course of the short to medium term. I'm going to focus on global liquidity conditions with a focus on the US, which is essentially the world's funding currency and tends to act as the epicenter for liquidity conditions, which then reverberate out to other currencies and countries. And I think it's fair to say after a decade or so of pretty easy liquidity conditions and interest rates hugging fairly close to zero and the Fed expanding their balance sheet, that the tides certainly change, and the Fed is the US Fed is starting to pull away the proverbial punch bowl from global markets, and it's expected that liquidity conditions will get significantly worse over the course of the next few months. And the main reason that we think that's happening is because of inflation. So US inflation at 8.5% for March is at a 40-odd-year high. And if I look at this chart on the left-hand side of this slide here, for the last decade and even before that, the majority of US inflation was coming from the services components, so things like housing and healthcare. And inflation was pretty consistently around 2%. And then as we moved into the pandemic, we saw first a deflationary impact as we weren't allowed to move around, and obviously things like energy prices came under extreme pressure. And then towards the end of 2020, when we started to see some level of normalization of economic activity, we saw this huge inflationary impulse. And it came predominantly from two areas. It came mostly from inflation on goods, which make up about a third of US consumer spending. So this sort of area over here. And goods haven't been inflationary. In fact, they've been deflationary for most of the last couple of decades. And then the rest of inflation, or the rest of the inflationary impulse, was coming from food and energy prices at the top over here. So I'm going to talk very briefly about those two things, starting off with goods price inflation. So what happened during the course of the pandemic is initially about 25 million Americans lost their job. The US government responded fairly rapidly to that problem to avoid it becoming a humanitarian issue. And they started mailing checks to people. They increased unemployment benefits. And what we've seen is historically, Americans have saved at a rate of around $1 trillion a year. And then as all this excess fiscal stimulus got thrown at Americans, they were able to save about $2.5 trillion more than they typically save. So all of that excess savings created this huge demand pull, predominantly for goods. And this was at the same time which we were seeing bottlenecks and supply chain constraints as a result of the pandemic. And the poster child for that was cars. Chip shortages prevented cars from being manufactured. And as people weren't able to buy new cars, they started looking to the secondhand car market. And this chart on the right here is an index of US secondhand car prices, which spiked about 60% over the course of the pandemic. And that's provided a huge inflationary impulse. We see that sort of rolling over now. And as Americans work through these savings and as supply chains normalize, we think that will all disappear. And then the other thing that's been hugely inflationary is food and energy prices. So in blue on this chart, the UN Food and Agriculture Price Index already earlier this year was reaching highs not seen for about a decade after a couple of years of pretty unusual weather patterns. And then we had the conflict in Ukraine, and Russia and Ukraine are big suppliers of food to the world. And obviously, as we bake in the expectations that there's going to be some disruption to supplies there, food prices have become extremely elevated. Same can be said for energy prices. So the brown line here is just the Brent crude oil price, which is back up above $100. Obviously, Russia being a big supplier of energy commodities to the world. And again, we're sort of pricing in the expectation that there'll be huge disruptions to supply coming out of there. And so all of this feeds back to what the US central bank is going to do about liquidity conditions. And what I've tried to show on this chart here is the expectations for US central bank policy over the course of 2022 and how those have evolved through time. So going back to the second and third quarter of last year, investors were expecting the Fed to hike rates once by 25 basis points during the course of 2022. And then as we moved into the last quarter of last year and increasingly into this year, when this inflation became uncomfortably high and looking to be less transitory, expectations for how the Fed would respond to that changed pretty dramatically. And so we can see now that the markets expect the Fed to hike rates to 2.5% by the end of the year. Rates the Fed's met twice this year. They've increased rates once. And so they need to hike rates by more than 2% for the remainder of the year. That's 6 Fed meetings to get to the level of expectations. And so I think what that means is essentially the market has become pretty pessimistic about how the Fed will tighten liquidity conditions. And it's actually quite hard to imagine them exceeding those expectations. In fact, if anything, it's likely that they won't be able to act as hawkishly as the market's priced in. And so a lot of the stuff is already in the prices, and we expect that as time moves on, we might see this tightening impulse not play out as badly as markets are currently pricing. And I'm going to leave it at there and pass over to Casey, who will talk about how that impacts.
Great. Thank you very much, Pete. All right. Good afternoon, everybody. So up until now, Pete has done a really great job of sort of explaining the real sort of volatile global environment that we currently find ourselves in. It's now my job to bring that back down to the local level in order to really look through this sort of current global volatility and understand, what is the situation in South Africa, given that there are various other sort of idiosyncratic issues currently at play at the moment. So, whilst the growth outlook is highly uncertain, we expect the direct impact of the Russia-Ukraine conflict on South Africa to be limited, given the minimal direct trade links. And while a positive terms of trade shock could theoretically result in higher export volumes, in practice, this is unlikely given the ailing Transnet rail infrastructure, port bottlenecks, and electricity shortages, which combined is likely to put a cap on mining output and thereby exports. At the same time, let us not forget the current KZN floods. At this point, it is still difficult to fully quantify the cost to GDP. However, the damage to infrastructure, businesses, and homes is already estimated to be in the billions of rands. Early estimates put the damage to infrastructure alone at 5.7 billion. And, this in turn will have a devastating impact on manufacturing, travel, tourism, agriculture, and many other sectors, which will inevitably cause huge losses through operations and, expenses in businesses, really. And while South Africa is, likely to miss out on the current commodities booms in terms of real GDP growth, higher export commodity prices will be positive for the current account and fiscus. The 2022 budget, which was presented back in February, reaffirmed government's commitment to fiscal consolidation while continuing to support vulnerable households. A balance made possible by the commodities-induced tax revenue windfall that we have seen of late. And despite the upward adjustment to expenditure, the spending outlook is clouded with risks stemming from further SOE bailouts, continued extension of the social relief of distress grant or implementation even of a basic income grant, and higher than budgeted public sector wages. Really given the downside risks to the global growth outlook stemming from the Russia-Ukraine war, the South African Reserve Bank's Monetary Policy Committee will therefore be wary to hike rates aggressively, as that would be negative for growth. Thus the SARB will really be cautious when considering the current path of interest rates, not wanting to raise rates too fast and thereby suppressing the current local economic recovery, but equally not wanting to raise rates too slowly and thus allowing inflation to rise rapidly, which will result in sharply high inflation across all the categories. So consequently, the latest SARB MPC meeting, which was held on the 24th of March, the SARB continued its gradual rate hiking cycle and increased the repo rate by 25 basis points to 4.25% as expected. However, it's important to note that, the debate notably shifted from being a no hike or a 25 basis point hike in January to being between 25 basis points hike or a 50 basis point rate hike in March. And really, this indicates a clear shift towards a generally more hawkish view by the MPC. And this can really be largely attributed to a combination of factors. Firstly, the bank's elevated 5% core inflation forecast for 2023. Secondly, the bank's expectation that the output gap will now close faster. in response to upward growth forecast revisions. And thirdly, the sizable lift in surveyed inflation expectations, even ahead of the war-induced food and fuel price spikes. So while South Africa has not been exempt from the current global inflationary pressures, it is important to remember that South African inflation remains really a different story to that of the UK, Eurozone, and more importantly, the US. If we consider the latest print, which rose moderately by 5.9% in March, we see now that headline CPI once again is nearing the upper limit of the SARB's target range, which you can see indicated there by the sort of gold or brownish bar in the graph in front of you. And what we see is that this modest annual lift was largely driven by the transport component of the CPI basket, which in turn was raised by the elevated oil price stemming from Russia's war in Ukraine. The government's reduction of the fuel price levy at the end of May will help to minimize upside pressure from the fuel component in the near term. However, elevated food prices are expected to remain a feature, especially as a conflict in Eastern Europe persists, which is really the sort of exacerbating global supply chain challenges. And I think it's also to remember that South Africa is a relatively small player in global agriculture. Thus, it's generally a price taker for various commodities. And looking ahead, further developments affecting the supply of commodities and other goods and services. So, for example, the impact of the Russia-Ukraine war on commodity prices, lockdowns in China, and of course, the recent devastating floods in KZN. These will drive monthly movements and continue to potentially drive inflation on the upside or the downside. And movement in either direction is entirely plausible at this point. Nonetheless, we still expect inflation to average around 5.7% for 2022. However, fuel inflation is a key part of this trajectory, and there's not a lot of certainty around the sort of future path of oil prices. So in total, we expect cumulative hikes this year will, to a large extent, depend on the evolution of the war in Ukraine. The shorter the war, the quicker the recent fuel and food price spike should reverse, or at least partly. And the SARB seems to be leaning towards a reasonably protracted war that is largely inflationary. And, based on the SARB's revised forecast, the bank's initial judgment is that global stagflation shock brought on by Russia's invasion of Ukraine will have a much more pronounced impact on driving domestic inflation higher than curtailing local real GDP growth. Our 2022 GDP growth forecast is now penned at around 1.8% year on year. And this is really attributed to our expectation that the ongoing war in Ukraine, as well as the lockdown restrictions in China, will weigh on global growth and thereby South African growth. In addition, we expect a slightly higher interest rate trajectory to be a drag on household consumption and thereby domestic GDP growth. And, furthermore, we think that the recent floods in KZN and the latest bouts of load shedding also pose a risk to growth naturally, as I sort of mentioned previously. And given security issues and bottlenecks on the Transnet railway and ports, we think that the impact of the positive terms of trade shock stemming from the Russia-Ukraine conflict on real GDP growth will be negligible, although there could be, real upside risks as well. And that really brings me to sort of the crux of my presentation today. And the key point that I really want to make is that whilst we are seeing the sort of rate hiking season now, it's important to sort of consider it in terms of a resumption to normal or a shift to the norm. If you look at the graph in front of you, which indicates the history of the SARB's MPC repo rate changes, if you look back to when just before the global COVID pandemic hit us, so around back in January 2020, South Africa actually had a repo rate of 6.25%. So this sort of gradual rate hiking cycle is really going to just take us back to the sort of pre-COVID norms. And, overall, whilst in this current volatile global environment, uncertainty is indeed really the only uncertainty there is, or the only certainty there is, the unpredictability of war, in our view, supports gradual rate hikes against the current economic backdrop and forecasts. to be honest, we doubt that a 50 basis point rate hike at this point will curb inflation or inflation expectations more than, say, 25 basis point rate hikes, while it may actually weigh on still fragile growth recovery that could ultimately be curbed even further, depending on how the war unfolds. So therefore, considering the March rate increase, we forecast another 75 to 100 basis points of repo rate hikes. So this would then bring the repo rate hike or repo rate to around 5 or 5.25% by the end of 2022. And, we also do acknowledge the risk of a sort of front-loaded 50 basis point rate hike in May, should more concrete signs of second-round domestic price effects emerge. Also, if the Fed hikes by 50 basis points, which at this point is looking quite highly likely, South Africa will be forced to follow suit essentially in order to protect the rand. So conversely, while South African growth momentum appears to have been robust in 2022 or more at the start of this year, we remain concerned that growth could potentially soften materially from the second quarter onwards as the combined impact of higher inflation and interest rates start to squeeze household income and non-commodity export volumes feel the drag of softer global growth. Nonetheless, we still expect the repo rate to rise to at least 6% over the next 2 years, although the unpredictability of the war in Ukraine makes it particularly hard to forecast the exact timing of each rate hike, really. That's my piece for today. I'll pass on over to Nolan.
Good afternoon, everyone. I almost said good morning there. It is wonderful to be chatting to everyone again, and thank you very much for joining us. So what has happened is Peter Little has talked us through the inflationary outlook in the States. Casey has pulled that back to South Africa, talked about the impact on South Africa. It now falls upon me to talk about what that really means for investments. By way of introduction, I've presented here a few times, and many of you will have seen me, but my name is Nolan Wapenaar, and I'm Co-Chief Investment Officer. If you do have any questions, please type them into the chat or the Q&A, and we'll address them afterwards, or we'll try to address as many as we can. In terms of talking through investing in inflation, the most common question I actually get these days is, how does one invest for inflation? Are there investment opportunities? Yes, there are investment opportunities. There are investment opportunities within equities. There are investment opportunities within fixed income. And I'm going to unpack that in the next 10 minutes or so. But in looking at that, it's actually very important to understand the nature of what's driving inflation, because that drives and dictates how you want to invest. So I'm going to look through the evolution of the inflationary impulse that we've seen and talk through the different stages. And the inflationary impulse that we saw started effectively on the left-hand side with it raining money. The US Federal Reserve, coupled with Congress, printed money and increased the amount of money in circulation. It was actually increased by about 30 to 40%, quite a significant printing of money. When you print money, usually you debase your currency. How do you invest for that? You buy gold, and gold is effectively your inflation hedge at that point in time. The point, though, is that much of that money didn't actually find its way into circulation. The Fed printed the money went and sat in savings, as Peter was showing, the $2.5 trillion that he was talking about, and that money was then sitting in a money market fund quite quietly. Now the Federal Reserve probably next week is going to start to effectively destroy the money that they printed by means of what's colloquially called quantitative tightening, effectively the reverse of quantitative easing. And as they do that, what you expect is the inflationary surge from potential even from the money that was printed will disappear. So very, very little impact from that, and consequently a little bit of a bump for gold, but gold hasn't been the ideal investment through this process. The next stage, as Peter was outlining, was that we saw durable goods prices increase significantly. Car prices, for example, because demand for cars outpaced supply. And it outpaced supply because you had bottlenecks in production, whether you're talking about supply chain issues, whether you're talking about we couldn't get chips, technological chips for the cars. Doesn't really matter. The point is there weren't enough cars. So how do you invest for that type of environment? Well, you basically want to own whoever's producing the goods that are in short supply, because you're going to see margins widen out, you're going to see increased profits. And much of last year was actually a discussion of increasing profits, significant growth in earnings, and significant increase in profit margins. As Peter little said as well, though, we expected the impact of that is going to start to wane. And actually, if you looked at this chart of used car prices right at the end, used car prices have dropped a little bit. And this element of inflation is fed through the system. So moving across to the right, where we're at right now is a world of inflation from commodity prices going up. And we're seeing commodity prices go up in the form of energy prices. So we're talking about thermal coal, we're talking about oil, we're talking about natural gas, and those prices have increased significantly. Commodities used in the production of goods and materials, for instance, copper, iron ore, aluminium, etc., that has increased quite dramatically. And then foodstuffs, as Casey was talking, has also increased quite dramatically. How do we invest for this type of environment? Well, you want to own whoever produces the commodities that have seen their prices go up. So you've wanted to own coal mines, you wanted to own platinum mines, etc. And that's been the key sort of investment driver for recent times. Looking at it, though, the question is, where are we at with that inflation cycle? And arguably, the USA is probably pushing past this element of inflation. We think that base effects, etc., will pull this element of inflation down quite significantly in the US in the next couple of months, probably next 2 to 3 quarters. However, it's important to note that the US and China are on vastly different timescales. And in China, what we've got is massive lockdowns right now, which basically mean the Chinese are not going to get to their growth targets. They can't with the number of people that are in lockdown. So in order to address that, what China is going to need to do is stimulate its markets again. In fact, they cut the Forex reserve rate today for their banks, and we expect more of that. As they do that, we expect that that's going to support the commodity cycle for a bit further. Seleho will talk about that more later. And then finally, on the right-hand side, in the USA, they've got a situation where as the economy came storming out of the recession, they found that they created a lot of jobs, and those 25 million people who lost their jobs all had opportunities to go and get re-employed, which is a great success. The thing is, they created too many jobs. So the US economy right now is sitting in a situation where the number of job vacancies exceeds the number of people who are available to work. In other words, the number of workers is less than the number of job vacancies. And that creates a massive problem for the US as well, because that means that if you run a restaurant, you need a waiter, or you need a number of waiters. And where do you find your waiters? You don't have a choice. You go and hire waiters from the restaurant next door, and you basically give them a 10% pay increase to move them across to your restaurant. And you start competing and bidding for your competitors' staff. This creates a massive wage spiral that actually will frighten the Fed quite dramatically. And this is one of the key factors that actually feeds into the US hiking cycle at the moment. I'm going to talk about that a bit more when we get to US bonds. Looking at it more closely, though, if commodity prices are rising, what do you buy? You buy whoever produces the commodities. And in our case, that means you buy South Africa. So let's look at the South African rand with that context. And very much the theme for the first quarter was buy the rand, buy South Africa, buy South African bonds, buy our platinum mines, buy our coal mines, etc. And this theme that carried through was all predicated on buy whoever produces that commodity. Thing is that the rand has weakened quite dramatically in the last week or so, and it's not showing on my chart here. Unfortunately, I sent the chart to get all the colors put in there by the marketing guys just before the rand weakened, so you can't see it. But in terms of the rand weakening, what's really driven that is 2 factors. Firstly, the rand has weakened from a lot of people were taking speculative positions in the rand. They've reversed those. And secondly, the narrative in the market has shifted from commodity-based inflation to one of, but the US is going to slow down. So from that perspective, what we've got is this dynamic that the market is almost in the tug of war of commodities going to be strong, particularly as China stimulates, but then you're going to see the rand, but you're going to also see economic growth slow down, and that's generally quite rand negative, and that's going to create this volatility. Longer term, though, we think that the rand's fair value continues to behave in accordance with our purchasing power parity model, which basically says we think that the rand is going to continue in a similar zone to where it's been for a while, and we're keeping our fair value for the rand at about 14.50 to 15. We think that in time it'll claw its way back there. That means that from an investment perspective, don't look towards the rand for or rand weakness for returns, but rather look for interesting opportunities abroad when you invest abroad. So looking at global bonds very quickly, where we're at is that there are job vacancies and the Fed needs to destroy jobs. The way they do that is they hike interest rates until eventually the economy slows down enough that the pace of job creation matches the pace of new people coming into the job market, and everyone's got an opportunity to work. So that's really what the Fed's objective is, and they're going to hike interest rates to slow the US economy enough to actually reduce the pace of job creation. So as they do this, the market starts. So the market narrative has for a while now been about about inflation and concerns about inflation. As the market realizes that interest rate hikes are coming and the extent of interest rate hikes, the narrative starts to shift towards that of a slowing economy. You're going to hear a lot of noise about a US recession. Our base case is there's no recession within the next year. I think it's quite unlikely. However, this debate is going to rage. As this debate rages, how do you want to invest for this type of environment? Well, when you're in the inflationary environment, what you want to do is basically hold cash and you want to hold value shares. However, there's that tipping point where the market starts to now talk instead about the slowdown of the economy, and that carries that narrative starts to come to the fore. I think we're close to that tipping point right now. That's the point where you want to start to actually move into long-dated bonds. You want to buy 10-year bonds to 30-year bonds. That's the point where you want to own a lot more quality shares in your portfolios. So you want to potentially look to reduce value. You want to own companies with good, strong margins, likely to grow through at a reasonable pace still. And Peter Armitage will chat about that in a bit more. So where will the money be made from a global fixed income perspective? We think that current bond prices are fair, slightly cheap. We think it's going to be volatile for a while we sort of teeter on the edge of this tipping point, but we know that we're going to tip over towards a slowing economy, and that's going to be bond supportive in due course. And we find that corporate bond yields of about 4% plus possible capital gains are quite attractive. Looking at South Africa, though, our inflation is different. Much of it is from, on the left-hand side, oil prices that have gone up, and we're absorbing sort of exogenous factors that are pushing inflation up. Certainly, we're not in the same position of having too many jobs. And as a result, our Reserve Bank, as Casey was saying, just wants to tap the brakes. They want to take the edge off inflation, but they don't really want to slow down our economy. Consequently, fewer hikes likely. That being said, we continue to see support from the commodities that are likely to continue for a while yet. So pulling that all together, we think that from a South African perspective, bonds are quite attractive. The fundamentals will continue to improve as the commodity cycle chugs along. And we think that the propensity for significant blowout increases in yields is quite low. What we have got here is a chart showing you the blue jagged line, which is the yield on the South African 2030 bond over time. And I've got then the red line on top, which basically is what the yield is today in today's markets. I did actually update this one for today. And the point I'm making with this chart is that if you look at where that red line is, there have actually been very, very few opportunities in the last 5 years to buy South African bonds and earn as much as you can earn today. So on any historic measure, South African bonds have become very attractive, coupled with the fact that we actually think fundamentals continue to chug along in the positive direction, makes South African bonds quite attractive. The bond is yielding 9.6% interest income today. It really doesn't have to do much to get you to your 10% yield that Peter Armitage was talking about earlier. So South African bonds are attractive. So pulling it all together, domestic bonds are cheap. The fundamentals are continuing to improve. Rising global rates are becoming less and less of a headwind because we think that we're at that sort of tipping point for the US narrative, and the yield is attractive. Just earn the interest income and wait, you're going to earn capital gains as well. So from our perspective, we think that this is a good time to increase durations. We think it's a good time to hold bonds. It's going to be volatile. However, it is in the long run going to work out very, very attractively for you. I'm going to end it there and hand over to Peter Armitage.
Thank you, Doug. So I'm going to tie that all together and pull it through into the into equities. And I think the one thing that we can be guaranteed of is continued volatility. As a few of the speakers have talked about, there's this kind of balance being reached. US 10-year bond yields have risen very sharply, and I'll show you on a slide that pretty high levels compared to the last 10 years. And equity markets have fallen about 10% globally. So we've been going back to kind of June last year. We've been fairly cautious on markets, pointing out that while earnings growth is fantastic and companies are doing very, very well globally, it turns out that the markets have been growing a little bit too fast, and they've come off 10% and kind of growing into their valuations. I think it's important to understand from an equity perspective, you've got this kind of underlying 8 to 10% earnings growth trajectory in the US. So if markets do go sideways, for a 1 year period, shares are roughly 10% cheaper. And over the course of the last year, with markets having come off 10% and earnings having grown by 10 to 15%, markets are actually about 25% cheaper than they were a year ago. So sitting in markets and waiting, we think is, we wouldn't, while volatility will continue, it's good to have some ammunition on the side. Staying invested in markets, we think still makes sense. The Ukraine war has changed global geopolitics forever, or certainly for the next few decades. And that's, importantly from a South African perspective, everything that Russia and Ukraine produces is mirrored by South Africa. So that's had a positive impact on South Africa. And the South African market has done markedly better than global markets. From an economic impact perspective, inflation is obviously the big one. There's lots of supply chain issues, costs going up, and you've really got to differentiate around the world between companies that benefit from that and companies that suffer from that. So a slowdown in global growth and possibly some slow interest rate hikes in SA and around the world. I think, where you've got to from a global perspective is almost 90 or 100% consensus that interest rates are going up markedly. And if things do slow down a lot, you could start to see a surprise the other way. So you've got to ask the question where we are in the cycle and what's priced in. From a market impact perspective, the volatility that we're experiencing on a daily basis at the moment, we think will continue, but that does present opportunities. And the key thing really is to understand for specific companies, their secular growth stories. We like being invested in companies that are growing. If markets are volatile and markets come off, we just want to know that the value of our underlying companies go up every year. And that's the thesis in each of the companies that we've got to check, that we'll talk through some more. And of course, COVID is kind of off the map from a news perspective. I think in South Africa, we are seeing some kind of resurgence, but COVID has become a case not so much of what the impact on the population is, but it's more about how governments react to it. And with the exception of China, and we'll come back to that, most of the governments around the world have kind of accepted that we have to live with COVID, and a lot of businesses are making a lot more money than they did pre-COVID. From a Chinese perspective, they've taken the opposite route. They're kind of going with the lockdown, sort of early COVID South Africa type equation. People have to stay in their homes. That's going to result in some pressure on the Chinese market. And that's seen commodity prices come off over the course of the last few days. where people are questioning whether the Chinese economy will slow down to an extent that commodity prices are in fact overinflated. Just before this conference call, there was a interest rate cut by the Chinese government, 1 full percentage point, which is very significant. So, you can view that positively or negatively. From a negative perspective, it means that they are very concerned about growth. From a positive point of view, you're sitting with stimulus from the second biggest economy in the world, which kind of plays into South African hands. From a market perspective, this is a picture of global markets. And just to make the point that it's now basically flat over the course of the last year. So this is going back to the depths of COVID, a big recovery. The market is in fact higher or roughly the same level as the Russian invasion. And it turns out that that's not having the kind of impact on stock markets that one probably would have expected. And in fact, if you went back to November last year and you'd painted the picture where interest rates are going to go up by kind of 2.5% to 3%, Russia's going to invade Ukraine, one would have expected the market to in fact do worse. So there is some potential in certain segments of the market for further corrections. But the point I made at the beginning is if you go through a longish period of flat markets, shares are becoming a lot cheaper. And if you have further declines, some pretty attractive investment opportunities are presenting themselves. This is the global growth picture. This was about 3 weeks ago. That 4.4% for 2022 is now the IMF has lowered their projections to below 4%. But still some fairly robust growth over the course of the next 2 or 3 years around the world. And this is the platform on which companies and hence equities operate. What keeps us cautious is the uncertainty that's out there with interest rates, although we think in the bond market a lot of that is priced in, and in the equity market in some shares that's being priced in. But world valuations are still kind of 5 to 10% higher than the 10-year average. So one could see, if you just had the market going flat for another 6 to 8 months, it's 15% growth, earnings growth forecast in the US this year, you get down to kind of average type valuations. So the real heat from a valuation perspective has been taken out the market, but that's not to say the market as a whole is sitting at bargain levels by any means. So here we see the earnings growth, and you can see that kind of tends to come in at about 8 to 10%. This is in the US. Remember that 55% of market cap around the world is in the US, and it doesn't mean just American growth. It's a good proxy for the world because about 35% of the earnings in the US market come from companies or operations outside of America. So 15 to 17% growth this year, and they're then reverting back to normalized growth. So the risk here, of course, is that interest rates go up too high, the economy gets pressured too quickly. And that's why we make the point that, all of the expectations are for significant interest rate hikes. And if anything, we might well be getting to the stage where a lot of that is priced into the market. A very busy slide, but I just wanted to make the point. If you look at the US dollar return around the world in the first quarter of the year, there's almost nothing in the green. So it's been a very difficult investment year. It's a time to kind of anchor down and, kind of revisit theses on companies, make sure we invested in the right businesses. And in the first quarter of the year, the Rand was about 2% stronger. The world index was down 8%, and the JSE Capped Swiss Index, at the end of the quarter, it was up 5 or 6%. It's now down 2%. But in dollar terms, being invested in the South African market, you're about 10 to 12% better than being invested in global markets. And this kind of mirrors what we were saying at the beginning of the year. Because of the global conditions and what was moving and the South African commodity story, we were quite bullish on the South African segment of the market. As we move through the course of the year, global growth slows a little bit. The Rand strengthens or the Rand stays, we're saying kind of 14.50 to 15 level. It might well be time to start deploying additional capital or allocating a little bit more to global markets. So the key considerations are where we are at this point in the cycle. Inflation driven by, we must remember that inflation was high pre-Ukraine for supply chain and other kind of other reasons, and that'll likely be higher for longer. But I think also to remember that you look at index levels, and I showed you the MSCI World with the markets basically flat over the last year. within that, there have been crashes in certain segments of the market. So things like Chinese technology, and everything that was, the kind of exuberance of 2020, the unprofitable tech companies in the US, those have all come back. A lot of them are trading at levels of pre-COVID. So we still think some of those shares are fairly expensive, but some very interesting opportunities and businesses that have got secular growth. In other words, that are growing irrespective of what economic cycles do. So 2 examples might be Amazon and e-commerce, where e-commerce penetration in the States, it's at about 16%. We think that'll go to 30% over the course of the next 5 to 7 years. And that's going to be independent of economic growth. So you want to be exposed to those types of stories where you don't need to be too concerned. As long as valuations are reasonable, you don't need to be too concerned about market gyrations, as long as you're comfortable with the fact that the value of your business is going to go up every year. The cloud segment of the market is a very similar one. Only about 20% of storage is on the cloud, and that's going to go to 60 to 80% over the course of the next 10 years. So you're seeing some fantastic growth numbers in the cloud businesses of things like Microsoft and Amazon. And you simply want to stay invested in those over the course of the next 3 to 5 years. So this is, these kind of classic market cycle graphs that we see, where the bull markets, the early recovery, the full recovery. It's important to understand where we are. In America, we're getting to kind of the end of the market cycle. So growth is very high. They're trying to pull it back. And one of the reasons the Fed's quite hawkish in terms of interest rate increases is the fact that the economy is very strong and they have got room to pull it back. On the other side of the spectrum, and what's much more impactful on South Africa, is China, which is earlier on in the cycle. And in stark contrast to the US increasing interest rates, China, just before this webinar, decreased interest rates. So we're at the early stage of the cycle and some stimulus coming through, which we think will continue to be supportive for commodity markets. But Seleho is going to talk more about that. You've then got to go and test the thesis of companies that we invested in. So a big disappointment for the market as a whole. I don't think anybody, or certainly none of the big investment banks around the world, was a company like Netflix, which is priced for growth. It's grown by 15 to 25 million subscribers every year for the last 6 or 7 or 8 years, and went slightly backwards in the first quarter of this year, and is talking about 2 million less subscribers in the second quarter. Now the market has to change its whole valuations spreadsheets. What does it grow by? It's probably kind of a 5 to 10 million subscriber growth business going forward, as opposed to a 10 to 20. And when market valuations are quite high, the penalty for being wrong is enormous. So an absolute crash in the Netflix price. But by contrast, if you look over the course of the last year, total streaming around the world has gone up from 26 to 28.6%. So the long-term secular growth trend for the sector as a whole is quite positive. There have been some new players like Disney Plus, but this is the kind of situation where we've got to assess our thesis, make sure that we think Netflix is still a growth business. And we think there's a lot of levers to pull in this business. They've got 222 million subscribers. They reckon about another 100 million subscribers absorb their product without paying for it in terms of password sharing. And that's something they're going to try and penetrate. And by contrast, businesses that, so the market and ourselves have got a lot more confidence in the secular growth story of something like Apple. If you look at the charts on the right-hand side, the total number of Apple devices around the world increases steadily every year. Probably more of a story is the amount of money they're making on an annuity subscriber basis per customer. My family currently pays Apple about 420 Rand a month. If you look at cloud services, music services, Apple TV, etc. So this is a company that we think, irrespective of economic conditions, will continue to grow, and hence you've seen the share price support. So I guess the point that I'm making is you've got to be quite company specific. Our analysts are spending all their days kind of revisiting and relooking at the company theses. We get investment reports from all the investment banks around the world, and making sure that we're on top of being in growth businesses at the right valuation. So this is a version of some of the pictures you've seen before, but bond markets, this is the 2013 taper tantrum, 2016 Trump election, and now the pandemic inflation shock. This is the US 10-year yield. And you can see bond markets react very quickly. And we've had a fairly extreme move and are back to levels which are quite high if measured over the course of the last 10 or 12 years. So one would argue or think that we've either priced in the inflation shock now or fairly close to have done it, but it takes a while longer for the equity market to do so. And this impacts all bonds, but equities, obviously, these conditions help some companies, they hinder other companies, and it takes some time for people to absorb and understand whether this impacts company growth rates. So the point I was making earlier as well about 2020 exuberance, the valuations, if you look back to after COVID, something like Zoom, we're using the services at the moment, valuations got crazy, up to $560. It's now down to $110. Something like Apple is now at a similar value. You can see the valuation difference between Apple and Zoom going back 2 or 3 years has now found its place. So you've got a company like Zoom at a similar type of price or similar type of valuation to a company like Apple. So the point that we're making and feeding through is companies are becoming fairly valued again. It might take a little bit more market decline or a little bit of time for things to get into bargain territory. But something like Zoom, we think is still got a great future, many years of pretty strong growth. We're not invested in it at the moment, but you can see the extremities that the market's prepared to apply to companies depending on the confidence in the growth rates. From a geopolitical perspective, the bottom right hand of this corner of this slide, is showing the big decline in US markets, declines across the board, and this is the kind of volatility that we're talking about. So from a global equity perspective, it's hard to be overly bullish on index levels, and volatility can be expected. So we think this is an interesting year to be invested in the market. You've got to have a little bit of bravery to see through. We think having some cash on the sideline makes it interesting. We think you'll see, some excellent investment opportunities surface, and some of those have started to come through. The bulls in the market, and they're quite a lot more difficult to find at the moment, is equities can in fact be a good place to hide with inflation. So as Nolan was talking, there's a lot of equities where inflation is good for them and can feed through. So in the local market, something like a Pick n Pay or a ShopRite. Growth is likely to slow. So growth is going to become more scarce. And we always try and, kind of get over the emotion of what's happening in the market in the short term and look 6 to 12 months out. And growth will become more valuable. If the Fed really does compress the growth rate of the economy over the course of the next 12 to 24 months in the US, the companies like Apple that can continue to grow will become more valuable and attractive again. We've got to have a heightened emphasis on valuation. In 2020, anything with a good story went racing upwards. I think you've now got to pay a lot more attention to valuation and the like. And then just to make the point and why one should have patience with markets, the underlying earnings growth of the companies that we own at the moment is in the kind of 10 to 15% range. So while it might not look like it on portfolios, the businesses that we own are becoming more valuable as each month goes by without the market coming off. Understanding the significance of inflation and interest rates. So South Africa is a commodity story. The raw materials index is at an all-time high. Seleho is going to talk more through commodities, but that's had a massive impact on our trade balance and the tax revenues that the government's been able to pull in. Looking further out, South Africa is a troubled growth story. It's kind of a 0 to 1.5% GDP growth story. So what you do have to be careful of is, and we've seen a bit of that with the currency weakening now, with commodities don't go up in a straight line. They've had a bit of a rolling over, and the currency weakened pretty quickly. So once the cyclical commodity story has turned, South Africa becomes a lot more difficult place to invest in. But we think this has still got some way to run. As a result of the good things happening in South Africa, business confidence has continued to edge up, and you can see it's it's at fairly high levels compared to the last 10 years. So let's look at the South African market. Within it, you've kind of got domestic shares, which are about 35%. That's important to understand. The South African market is dominated by non-South African companies. So the South African economy is not the South African market. But within that, you've got commodities, which are kind of 35% of the market, and financials, which are about 30% of the market. And the big segment there is banks. Our banks have done extremely well. You can see in this chart on the left-hand side, the best 12-month US dollar price performance in emerging markets. But even after all of that, a lot of that growth has been about recovery from beaten down levels. You can see the forward PE multiples available in our banking shares. So something like an ABSA, still only a 6.5 PE multiple and 8% dividend yield. So we still think there's some more action in the banks. We think the easy money is being made. But if companies can grow at 10 to 15%, 6.5 PE multiples, 8% dividend yields, we certainly want to have a fair whack of that in our portfolios. From a South African domestic perspective, this is quite a nice chart I got from Sun International. This is their income trend, and this is basically the COVID waves. As you'll understand, their income goes through the floor when people can't get out. And they're now trading in the months of January and February above pre-COVID levels. So this has been an interesting share to trade. Went all the way down to 13 Rand, up to an excess of 30 Rand. A little bit cautious now, given what's happening with COVID in South Africa, although our base case is we don't expect government to get into radical lockdowns. No South African investor presentation would be complete without talking about Naspers, which has been the bane of every growth investor's life in South Africa over the course of the last 12 months. The share's down about 20% for the year. But if we take a step back and look at it unemotionally, Naspers is now trading at a 65% discount to the sum of its parts, including the 10-cent valuation, which in itself is quite beaten down. But the market has basically punished the company for resisting any meaningful attempt to unlock the discount. Now, what we talk about unlocking the discount, if Naspers was to unbundle 10 cent, the value of 10 cent is more than double the value of the Naspers price. So market conditions, we speculate, might force the company into some more significant action. We wonder why 10 cent doesn't buy Naspers shares. It's buying back its own shares already on the market. And if the companies were to reach some sort of agreement, they can buy their own shares back at about a 60% discount. Tencent itself has come off quite dramatically, as all Chinese tech shares have. And you can see that it's trading at its close to its lowest valuation over the course of the last 10 years. And if you strip out its investment portfolio, it's trading at about a forward 13, 14 P multiple. Naspers, in turn, because of its discount to that, is trading at a P multiple of about 7 or 8, which nobody would have believed if you'd looked back a year ago and projected through to today. So we think that Naspers might have reached it certainly has reached the point of capitulation. It is important what the Tencent share price does. And we certainly would want to, for anybody who's been through the pain of Naspers, to make the point that 1 cent statement saying that there's any kind of meaningful corporate action could result in the share price doubling in a period of 10 minutes. We're not saying that will happen, but if that does happen, the optionality inherent in that equation is certainly something you want exposure to. I just pulled out a slide from a very recent Goldman Sachs report where they kind of looked unemotionally at the Chinese tech sector, which has taken absolute pasting. And if you just look at the red block there that I've highlighted, their target prices for the big Chinese tech companies are up between 50 and 150%. And that shows you the extent to which the companies are trading at very attractive multiples. The earnings growth for these companies for the next few years is projected at 23%. They've got 75% upside in Tencent, Alibaba 73% upside, JD.com 93% upside. So, these companies have been plagued by Chinese regulation, bad sentiment, and, lots of issues that we've talked about in recent webinars and written material. But it's important to understand the potential upside. And, people see these kind of returns and want to put their whole portfolio into it. We're certainly not proposing that. But we do think in a balanced global portfolio, it does make a lot of sense to have exposure to a segment of the market that's got this kind of upside. So depending on, valuations like this don't come around unless risks are high. So for the risk-averse investor, we'd probably still avoid it. But for people who are happy to, kind of have a mix of risk and return, it makes a lot of sense to have some exposure to this upside. So from an approach going forward, we're cautiously optimistic on select growth stocks. We're growth investors. We like to be invested in businesses that are fundamentally growing. That's worked over the course of the 10 years of our lives, of the life of Anchor. It's been a pretty tough space, and all growth managers have battled over the course of the last 12 months. But we do believe you've constantly got to test whether the growth stories for the companies themselves are intact. And if they are, you want to take the kind of opportunities that are being presented and will be presented during the course of the year to position your portfolios with the companies that can grow nicely for the next 5 years. Secular growth will become key. And as I said, growth will become more valuable towards the end of the year, especially if the economy, if the Fed is too hawkish in its actions. From a local perspective, tactical positions and hard commodity producers, Seleho will talk you more through that. I specifically haven't talked too much about resources in this presentation, but still an interesting space, we think. And some heightened emphasis on valuation in the face of rising rates and the general tightening. So from a domestic perspective, the SA market's likely to stay fairly well supported. We've got tactical positions in commodity shares. We've had a little bit of a taste over the course of the last few days that, the commodity upcycle doesn't last forever, and you've got to watch it pretty carefully. You don't want to be on the wrong side of it. But it's, if one can be tactical about it, there is money to be made with massive cash flows coming through from these businesses. Some decent return from domestic shares. High dividend yields are very supportive. We showed you things like the banks where you can earn 6, 7, 8% dividend yields. And in a world where returns have been recently, and we think for the next period will be quite hard to come by, those dividend yields are fairly attractive. And then just to make the point that, at the risk of irritating people who've lost money on Naspers, as almost every kind of SA investor has over the course of the last year, one has to remember the big optionality in the business. So across the spectrum, that's domestic equities, global equities, volatility, but some opportunities arising. From a domestic fixed income perspective, domestic bonds are cheap. There's a yield of 9.5% to 10%, and we think some capital gains at some stage. From a global fixed income perspective, corporate bond yields of 4% plus a possible capital gains, we think look interesting. And even US government bonds, for the first time in many, many years, offering a return that's fairly attractive relative to the risk inherent in them. So tying that all together, from a local perspective, the most attractive spaces are where you can get kind of a steady, predictable income stream, being bonds and listed property. Listed property, as we said, we haven't got slides on it, but you're looking at about 8% dividend yield plus a bit of capital growth. The dividends are far more predictable after the companies have rebased following the horrors of COVID. And then we've pulled down on and gone to neutral and local equities after a fairly good first quarter, but still a pretty decent return and a higher return than global equities. Over into the global side, a below average return from global equities, but this is the 12-month view. You're going to see a lot of volatility within there. Government bonds about 2.2% and corporate credit looking pretty attractive. So that's our mix. I'm now going to hand over to Seleho, who covers our resource sector, to talk you through how we're seeing that segment of the market. We'll then follow on with a Q&A. And if I could ask you to put your questions into the Q&A tab rather than the chat tab, it's just a little bit easier to manage and assess the questions.
Thanks, Pete. So in a world of rising inflation, the commodity sector definitely comes into focus more. If we look at what's happened over the last year or so, we've seen several commodities hit all-time highs. On top of that, we've seen several of these commodities hit prices that we haven't seen since 10 to 15 years ago. And what's very impressive about this is just how broad-based it is. We're seeing this commodity price strength in energy, base metals, bulk commodities, soft commodities. It's been extremely broad-based. So it's not just one pocket of the sector. Another illustration or way to illustrate the strength we've seen over the last year or so is this chart, which shows weekly moves in commodity prices. And in March of this year, we actually saw the greatest increase in commodity prices on a weekly basis on record. So that's going back several decades. And again, I think this just does a good point of illustrating how strong the price strength has been over the last year or so. But if we actually take a step back and look at the resources sector, we need to keep in mind that the resources sector has actually been in a bull market since about the end of 2015. So if you look at the resources sector and compare it to the broader JSE, which we use here or represent here by the CAT SWIX, if you look on over any short or medium term period, so whether it's year to date or 1 year or even 3 years or 5 years, resources have generally outperformed the broader JSE quite comfortably. And that's because commodity prices have been strong, not just over the last year, but really since that bottom near the end of 2015. And when we're looking at the JSE and the bulk and base metal miners on our market, one thing we do need to keep in mind is that it's a segment of the market that's actually quite concentrated in terms of its profit split. So if you look at the profit split by company, you can see that it's actually only a handful of commodities that really generate the majority of profits for these companies. It's iron ore, coal, copper, and then to a lesser degree, platinum and a few other metals that make up the majority of profits for these businesses. So that's something that we do need to keep in mind when we're looking at investing in commodities on the JSE. Now, having said that, these companies are very profitable at current prices, and valuations aren't demanding. If you look at one valuation measure, which is free cash flow yield, free cash flow yields are currently between 15 to 25% for the diversified miners, with Thungela being a huge outlier at about 60%. To put this into context, South African government bond deals at the moment are currently yielding about 10%. Now, obviously, mining companies or shares in mining companies are a lot riskier than SA government bonds, but I think it illustrates that yields or valuations in the commodity sector are attractive, partially because there is quite a bit of uncertainty in terms of how long these prices will last. So, the market just isn't sure how long some of these record highs will be sustained. And definitely, I think trying to call the top of a resources cycle is hazardous at the best of times. But what we can say with quite a high degree of certainty is that we are not seeing a huge supply response or production response from these mining companies. In the 10 years leading up to 2020, they spent an average of $36 billion on CapEx. In 2020, they spent $30 billion. Now, okay, granted, COVID would have had an impact on that 2020 CapEx number. But even then, we're still seeing CapEx numbers now that remain below where they were at the peak of the last cycle. So CapEx numbers are pretty muted. And if you look at actual production volumes, if you look at, for example, iron ore volumes, platinum volumes, generally coal volumes, volumes are quite weak, and you're not seeing a huge supply response. So we think that demand is more likely to be an issue for commodities going forward rather than supply, at least in the short to medium term. The other thing that's been very supportive of prices has been the Russian invasion of Ukraine. Russia is a big producer of many commodities, in some cases the biggest producer, for example, palladium. And the political backlash that we've seen to that invasion has put a lot of Russian supply of commodities at risk. And that's been very supportive for pricing. One great illustration of this has been the thermal coal market. So thermal coal prices are currently around $300 a ton. If you look here versus its history, that's clearly an exceptional price. At this price, everyone in the thermal coal market is making good money or good margins. And within the JSE, the company that's most exposed to export thermal coal prices is Thungela. This company was spun out of Anglo American in June of last year at 25 Rand a share. So it's up roughly 10 times in 10 months. And that's really just a function of that, the last slide where we saw what happened to thermal coal prices. But what's interesting about this business now is that after listing at 25 Rand a share, we estimate that it's generating about 13 Rand per share on a monthly basis at current commodity prices, which just illustrates how strong the cash flow generation is for not just this business, but the sector as a whole. And I think it does a good job of illustrating how even after the share prices have run to the degree that they have, valuations at current prices, commodity prices, aren't hugely demanding. Clearly, we don't expect thermal coal to remain at $300 a ton over the medium term or long term. But I think what we can say is that this company is very cash generative at current prices. And clearly the market has some caution around the sustainability of those commodity prices, or in this case, coal prices. And as a result, it's quite an undemanding valuation. So if you look at the resources sector, there has been money to be made in this sector. We think there is still potential for money to be made in the sector. It's a sector that we wouldn't buy and hold by any means. It's obviously very cyclical, but it is one where, given where commodity prices are at the moment, it's one where we continue to watch very closely. Thanks. I'll hand it back over to Pete.
Okay, thanks, Seleho. If I can ask guys to just get their faces back on the screen, there's a few questions I want to ask. And we'll try and keep it going, limited to about another 10 minutes or so. View on Coronation, a question from one of the attendees. Historic PE of 8 times and a dividend yield of 11.5. I think to understand the fundamentals of Coronation, they got to about a 540 billion Rand assets under management about 5 or 6 years ago. Which was kind of a massive market share in the South African context. So what they've kind of achieved over the course of the last 5 years is flattish AUM, where they've had withdrawals from the AUM, but at the same time the market's kicked up. So you've had kind of a fairly flat turnover line over the course of the last while. It pays out most of its earnings as a dividend, so it becomes kind of a market beta player with a little bit of with a very nice dividend yield. So a dividend yield of 11.5%. You must compare that to Nolan's bond fund at kind of the 10% yield, but that doesn't have any underlying growth. We think there could be a little bit of capital growth coming through there. So yeah, I mean the price is absolutely tanked in line with markets. I think if you've got a fairly positive view on the market in rands over the next 12 months. And as you've seen, our view is for kind of 5 to 10% type returns. You could well get Coronation bouncing back and a nice dividend yield. So it's not a flyer. I don't think it's something that's going to give you a massive return. But as we were talking about earlier, dividend yields becoming even more attractive. There's another question on thoughts on Prosus versus Naspers. Let me take that as well. I think we run charts on the one versus the other. At the moment, they're kind of in a little bit of equilibrium. There is, however, about a 65% discount in Naspers and about a 45-50% discount in Prosus. So you ultimately, if there were to be any corporate restructuring, you'd want to be in the one with the biggest discount. So at this stage, we'd probably marginally favor Naspers over Prosus. If you're a long-term holder, that certainly is the case. Seleho, I'm not sure if you've answered this. With China slowing down, do you really see a reasonably long demand for commodities? Maybe you just want to put that in a bit of context.
Sure, Pete. Yeah, so obviously China is the biggest consumer of commodities. And think if you go back to that one slide I had with capex for the mining sector, we don't think that supply is likely to be the big risk to the resources sector. We think it's likely to be demand. So we do think that is the biggest risk is demand, and most likely Chinese demand. And I think that's to some degree reflected in our portfolio. So for example, our iron ore exposure is reasonably low. It's comfortably below benchmark. So we've tried to take exposure to commodities where it's not just dependent on Chinese fixed asset investment.
And then either Pete or Nolan, if you want to take this, inflation, is it not being over-talked? And won't technology ensure inflation doesn't become a long-term problem?
I can have a crack at that. So technology has been deflationary, and that's why we haven't really seen goods price inflation much over the last couple of decades. The trouble with inflation is that it's primarily physical, but then psychological. So to the extent that people believe inflation sticks around, they tend to start preempting it, and then it becomes self-fulfilling. So, for example, if everyone thinks that inflation is going to be running at 5% in the US, then landlords are wanting to insert 5% escalation clauses into lease agreements, and employees are wanting to start wage negotiations at 5%. And if retailers are expecting their rents and wage costs to go up at 5%, then they're going to put up their prices by 5%. So inflation can become self-fulfilling from a psychological perspective, regardless of what's happening underneath the surface. And that's why the Fed is sort of certainly talking up a big game in terms of getting on the front foot, getting ahead of inflation before it becomes too entrenched and psychologically it sort of sticks around for longer than we wanted. But certainly, yeah, technology, if we revert to a sort of pre-COVID environment where supply chains are all unclogged and people tear through all of their excess savings and the psychology of inflation doesn't become entrenched, then technology should become deflationary again.
Nolan, if I can basket two questions for yourself and possibly Casey. So outside South Africa, is there a region or country where a solid 8 to 10% income, so government or high-grade corporate, is available, then investable via a US dollar priced fund? In other words, is there an investment case for income outside of South Africa? And then along with that, a question saying, what are the thoughts on inflation-linked bonds at this point in the inflation cycle?
Sure. So let's answer inflation-linked bonds first. And really what we've said for much of the presentation today is that central banks are now going to nip inflation in the bud in order to prevent it becoming psychologically entrenched, as Pete was saying a second ago. That means that the central banks are going to make inflation go down. Inflation-linked bonds work well when inflation is rising. When inflation is actually declining, they're not great investments. And therefore, I think we're quite late in the day for inflation-linked bonds by and large. There are a handful of inflation-linked bonds, generally very short-dated ones that screen quite attractively, the ones maturing in 2025, for example. And that's just because short-term inflation is high enough that your income on those bonds is significantly higher than what you're going to earn on cash. So it's a very interesting carry trade. But by and large, long-dated inflation-linked bonds, I think is late to the party. In terms of looking at the rest of the world, the way we look at it is real yields. So we'll look at nominal yields. In other words, what does the bond pay minus the inflation in that country? And that gives you a sense of the real yields. In terms of absolute yields, we can probably get you 20, 30% in Turkey, for example, but you just don't want to buy that right now, not while the inflation is running at 67%. We can get you significant bonds. We can get you 20, 25% yield in Ghana, local currency. Again, you don't really want that right now. We can get you 15% in Nigeria. On a real yield basis, saying, hey, let's look at countries that we probably compare ourselves to that are reasonable. Where do you see similar sort of real yields? Indonesia is a good country at the moment. Its bonds are certainly competitive with ours, if not actually probably slightly cheaper. And Chile would be another country that I'd look at for real yield. So they are out there in domestic currencies. When you convert to dollars, because you're saying, can I buy real yield or can I buy yield in dollars? It gets a bit hairier. You start looking at, well into the junk bond space. There are opportunities. Nigerian bonds are trading at 7-8% in dollars. I can point to Brazilian bonds, again, actually Chilean bonds, etc., which are dollar denominated. It takes the currency risk out of it, and you're going to get those sorts of zip code returns, obviously with commensurate risk.
Nolan, what is or Casey, we're seeing massive 8.5% inflation in the US, and the South African basket is much more sensitive to oil and food. What are the chances of South African inflation surprising on the upside? It's kind of intuitively quite difficult to see why US inflation is so much higher than ours when our basket has got a lot more of the goods that are going up quite sharply.
Casey, I wasn't sure. Go for it, Casey.
I wasn't sure if you were going either, that awkward pause. So I think if I understand the question correctly, is basically why is South Africa, or the chance of South Africa spiking much like in the US? And I think it's important to take a step back and consider the drivers of US inflation before the Russia-Ukraine story. At the end of the day, the US was suffering from additional inflationary pressures from the COVID sort of unwind, supply chain issues, gridlocks, etc., which was already spiking inflation before the war started. South Africa, up until that point, had been fairly moderate. And then, of course, Russia invaded Ukraine and caused a spike in oil and food prices, which is starting to push down into South Africa. The listener was right with saying that our basket largely comprises of food, etc., there's more volatile categories. But I think it's important to remember, if you consider core inflation, which is a real driver of your sort of underlying inflation that excludes your food and energy prices, that is still sitting at 3.8% from last month, which is still fairly moderate. And at this point, considering oil has actually come into a bit more of a stable point, albeit at a higher levels, we believe that South African inflation will moderate around the 6% band, albeit slightly higher or lower for the next few months. But from there onwards, the second round effects and those base effects will start to kick in, which will help the print sort of moderate going further. I'm not sure, Nolan, if you want to add anything to that, or perhaps Pete, a little from the US side.
Yeah, let me summarize it. South African inflation is going where the price of oil goes in rand. So the two factors to watch are oil price in US dollars, because Brent price is in dollars, and the rand dollar exchange rate. The significant weakness in the rand we've seen in the last couple of days, I want to almost say week maybe, is going to push inflation higher. If it sustains itself, that could actually push us outside the band. But those are the two key risk factors that I'm focusing on.
Then there's a question, do you believe that the dividend yields on properties redefined at 13.5% and mirror at 11.5% are sustainable? So maybe to talk specifics. So across the property sector, you've got some very different dynamics in different properties with the different mix of SA, offices under some pressure, etc. So you need to look at company specific. Redefine, to put the metrics in context, it was basically a 10 Rand, 11 Rand share earning, giving you a dividend of about R1. So what's happened after COVID, through a combination of office rentals, a few years of reversions, the sustainable dividend yield has come down to about 50 cents, probably growing to 60 cents over the course of the next little while. And the share price has come down in sympathy. It's sitting at around R4.50. So redefine. So it's important to understand that the dividend you're getting now is a rebased dividend. It's taking into account what's happened in the property market. And importantly, it's not, all the property companies, what's changed with all of them is they're no longer paying out 100% of their income as a dividend. So the actual dividend is, generally 75 to 90% of a company's earnings. Redefine have got a nice, so that in last year's numbers, which was about 50 cents, they had some write-offs from a COVID perspective. Those won't be repeated, so you've got some growth there. And then the acquisition of the rest of EPP will further boost the dividend by in the region of about 5 cents or so. So we think a dividend this year on a R4.43 share price, a dividend this year of around 55 cents, and then growing to probably 60 cents the year after. So I mean, it's pretty high yields. I think it's at lower levels. And I think in the SA property market, what you'll see going forward is continued reversions of 5 to 15%. In other words, when leases come up for renewal, they get renewed at lower prices. But if your average lease period is 4 years, you've got 3/4 of your property yields going up at 6 or 7%, and you've got 1/4 coming down at 5 to 15%, which probably lands you up with in an average South African property portfolio, kind of flattish to up a few percent from an earnings point of view. You then got quite on our property markets, a lot of companies which have got investments in Eastern Europe, which is very different dynamics, and economy is growing a lot faster than South Africa. Obviously, the potential impact from companies bordering Ukraine is somewhat concerning, although our base case is they won't be impacted in the short to medium term. But obviously, you do have that tail risk of a war spilling over. So yeah, I think I think in a Redefine and a Emira, the yields are sustainable at pretty attractive levels. But the market has been quite discerning. The way it's pricing, it's implying that the quality of Redefine's rental streams aren't as high as something like a Growth Point, which is trading at closer to kind of an 8.5% dividend yield. So, the answer is probably a mix of properties. That's what we do in our property fund, coming out at a combined yield in the region of about 9%, with probably 4 to 5% dividend yield growth going forward. So, coming back to our asset allocation slide, that was the logic behind being quite positive on listed property. And when we say positive, we're not talking about a 20% return. We're talking about a total return in the region of 10 to 11%. Right, folks, I think that answers most of the questions that were probably not fully answered in the presentations themselves. We aim to finish at 3:30, which we're kind of doing. So we had about 650 people watching this presentation. It's an honor to get all of your attention for such a long time period. Thank you very much. If you've got any questions, feel free to chat to your representative at Anchor or give any of us a call. Thank you very much and enjoy the rest of the day.